What's going on, traders? Welcome back. Hope you're having a good weekend. If you're new to the channel, my name is Prince. I've been trading the foreign exchange market for about 10 to 11 years now, and the goal of this channel is to help you do the same. So you're looking at the title, you're looking at the thumbnail. Today we're going to help you beat market manipulation, how to win that game. So in store today, we're talking about things like fake outs, breakouts, how to know when the market is going to stop, slow down, how to jump on the trend, how to get off the trend, how to know when to take targets off, where to take targets off, where to enter, those kind of things, the fun stuff, right? And then why you can do all of those things, do them right, and still lose the trade, right? Because losing trades are just one thing that we can't get rid of when it comes to trading. Unfortunately, we have to live with it. So the way I'm going to do this is I'm going to show you a clip of a market breakdown I did a few days ago. And then I'm going to show you an after footage as well of what happened after all the breakdowns to demonstrate these points. So without further ado, let's get into it. Yes, what's going on, traders? Hope you're having a good Sunday. So today I wanted to talk about something. Something just came to me, and I just wanted to, remind you guys about, the way the market moves. Sometimes it can be counterintuitive to what your brain is telling you. Like sometimes we'll fake ourselves out. Essentially how to know when the market is going to, for instance, stop or retrace or break out, or essentially without you, jeopardizing and essentially messing up your trading because you wasn't looking at the right thing. Now, let's take Aussie yen for an example, right? Now, Aussie yen has been incredibly bullish the last few weeks. You can see starting from here, we've had a clean break to the upside and it just keeps going. And then the last week by itself, there's been like 1, 2, 3, 4, 5, 6, 7, 8 candles, 8 green candles. Now, that's all good and well, but the question is, how do we get involved in this? Now, if you've been trading, one of the most difficult things is just to figure out how to get into a trade that just keeps going up and doesn't slow down, right? Now, that's what I'm going to talk about on this, especially on this currency pair. Now, the way I would go about this is that I would ask myself, well, if the market is going to be bullish, where is it most likely to slow down, or at least, give me a chance to get in? Where is it going to stop, right? Now, that's where the concept of structure levels come into it. Because if you look left, you can use structures always act either as a barrier or as a catapult, right? Now, what does that mean? Structure is either going to be some kind of a stop to a trend. Now, if for instance, in this example here, you have a major structure looking left. If I drop in an arrow right here, now this could easily be a stop to this massive bullish trend. Now, if the sellers are strong enough, and we've already established here that they weren't because we blew past it, but this could have been a very clean area for you to get into a sell. Now, that kind of brings me to the whole point of that I'm trying to make here, that just because you have a bias to sell doesn't mean you should just stick with it, because clearly we've broken and closed above that. So now you should always have to have a chance to rethink your strategy, take something else into account, and don't just box yourself into one idea. Now, there's so many buyers in here, and maybe you didn't get a chance to buy when it was at a clean area to get in or whatnot, but you can always wait for that structure level. Now, you can see the market was just moving straight up. It's very difficult to get in, but if we come up to this level, we can say to ourselves, if we hit this yellow line, right, and we put it like a reason for entry. Now, again, this is the next lesson I want to give to you guys. Don't just make a decision and then enter willy-nilly. You need to have a reason for entry. Now, what do I mean by reason for entry? You need to have some kind of a candlestick formation. You need to have some kind of, maybe you use some kind of a signal, like a RSI. If you look to the bottom left, you can see right there, the RSI is 91.8. So it was clearly overbought on this instance. But the problem is, we have had a break and close above that structure level, right? So that right there alone by itself has already completely invalidated this trade. Now, I've had in my trading plan that if you have a break and close above a structure level, that tells me that those sellers in this area are just not strong enough to hold the bullish momentum coming its way. And I was right about that, because if you see, we have had a breakout and the market has just kept going up. Now, the question is, well, if you're looking to be a seller, how do you get involved in this? Well, the question is, you shouldn't have. And if you did, you would have lost. You should be a buyer here. Now, how do you do that? We've established that the market was bullish, that's one. We've established the market has broken and closed above a major structure level, that's two. Now the question is, how do we get involved then? Well, you can always just wait for the market to retrace, which is exactly what it did here. Because usually what happens when the market breaks out of a very, very major structure level is that it takes a break, takes a breather, or it stalls. You can see a bit of a stall here. This is kind of like a wedge pattern. Some people call it a flag. It doesn't matter what you call it. Essentially, the significance of this is that the market is taking a break. So the market broke out of this, kind of retraced back a little bit, but not really a retracement. It's kind of taking a break, and then it broke out again. Now, it broke out and came back to retest where? And the previous level of structure. Now, this is an area you can actually look at and say, well, if the market comes into this area, I'm looking to buy, and I'm looking to take targets where? Now, this is the beauty of it, because if you look left, it's just almost nothingness. Looking left, there's nothing until we get to where? The next area of structure that we are looking to, that the market is most likely to get to, would be this level here. Because again, structure acts as a magnet. Now we've broken out of this level here. Now the next area to conquer would be all the way up here, this level. Now how do we get there? Well, you already have a strategy, right? I just told it to you. Market has come in. Market has broken out, come back in, retested the minor structure. And all you have to do at this point is just say to yourself, well, I'm either going to take targets, maybe like a 1-on-1 or 1-to-1 or 2-to-1, or I could just hold this trade until we get all the way up here. Now look at that risk to reward. That's an 8.2 to 1 risk to reward. Now, do you realize you could have easily taken I've seen a lot of people just say, do you know what, I can't get involved in the bullish trend. I'm just going to wait for the market to smash into a major structure level, and then I'm going to sell it back down because this has to stop eventually. Well, it will stop eventually, but the key is to realize, when is it going to stop and how do you get involved? Now, that's more important than knowing that the market is going to stop, because of course the market is going to stop. It can't just keep going up forever, right? But it doesn't help you in any way if you just throw your money in the pit and just let it watch it burn. Having a reason for entry and being able to switch your bias at any point is very, very important in the foreign exchange market. Now, let me give you another example of this. Now, CAD yen is actually quite similar to. Let me just look at the daily now. CAD yen has been flying as well. We've had a break above the previous structure level here. Now the question is, well, where are we going now? The next level of structure we're going to get to, or we're likely to get to, is this one here. Now I've drawn in a zone. Now I'm not here to teach you guys about zones or anything like that, but I've also put in like a yellow line as well. Essentially, the point is I'm trying to make is that this is where the market is going to. Now the question is, well, how do we get involved? Now I've mentioned before, we can wait for some kind of a retracement, because you can see the market has been moving quite straight up. There hasn't been much of a retracement on this currency pair. But if we have a look here, you can see a tiny retracement. The market came in here, broke to the upside, retraced a bit. Now this is an area you can be looking to get involved. You can say to yourself, well, the market has retraced back into this area. Now I'm going to find the reason for entry, some kind of a candlestick formation. Maybe you drop down to the 15-minute time frame, and in that time frame you see maybe the RSI is overbought, which it is, right? There could even be some kind of I can see a bad pattern in there. That's sweet. That can be your reason for entry. Essentially, your reason for entry should be consistent and always, it needs to be happen regularly, and it needs to be consistent throughout your trading. Now, if you find that reason for entry, you can then say, okay, well, this is my reason for entry. This is my justification for being in this trade, and then I can just hold this all the way to the next level of structure. That is a 5.5 risk to reward. Now, again, just like in the previous example, chances are there's a very good chance that we're going to get to that level of structure. And first of all, this might not even get to that level of structure. But if you haven't found a reason to get in here yet, if you didn't use that as a reason to get in, and now you're looking to get into a sell in this currency pair instead, watch out for that same pitfall that I talked about on the Aussie yen, because if we don't get some kind of a reason for entry, some kind of a double top or candlestick formation, you could easily be throwing your money, flushing it down the toilet. If we get to that level and you don't find your reason for entry, and in fact, if we have a break and close above that area, then you need to switch your bias very, very quickly. Don't let your brain, don't let the market fake you out. Just if it's not a breakout, it's probably a fake out, right? So if we get to that level, you don't see anything, and if in fact the market tells you that it's going to keep going up, and you stick with the same bias that it's a major structure level, so the market will reverse, then you're most likely going to lose that trade, right? So if we have a break and close above, find the reason. Maybe like a retracement or some kind of like a bullish wedge pattern. Find the reason to buy. Okay. Now I think there's another example on the Euro Aussie. So this has already been drawn in for you. Now this is an example of how you can squeeze every single thing out of a trade. Now, Euro Aussie, if you look on the daily chart, has been extremely bearish. We've been bearish. We came down into this. If you look left, you can see it's been tested. This structure level has been tested right here. That's the first yellow line you see, and the next yellow line I drew in because that's the next level of structure. So you have two levels of structure, which are most likely going to be tested in the next few days or weeks. Now, how do we get involved in this? Now, the market has already told us that it is incredibly bearish. That's one. Market has already also told us that we are now in a state of indecision, because if you have a look down here, this is what I call indecision. Market is kind of moving sideways. Now, how you can get involved in this before the market, because essentially, usually when the market breaks out of these types of structure levels, like major structure levels on the daily, it moves very, very quickly. So it breaks out and it just goes. There's usually, again, no time to get in. That's why you have to know. That's how you have to make your analysis before the market, makes the move, so that you know how to respond. You're not being reactive to it. So right now we've had like a sideways flag pattern. Now if we have a breakout to the upside, to the downside, which we actually already have, you can easily say, put your risk to reward and say, well, market is telling me that it is going lower, so I'm just going to put my stop above the previous structure level of this channel, and then put my target at the next level of structure, which I showed you already on the daily chart. Let me show you again. Right down here, because again, structure acts as a magnet. Structure attracts price, and major structures on the higher time frame attract price, like honey and bees, right? Or is it honey and flies? I have no idea. So that's how I would play this. Now again, it's Sunday, so breakout has already happened. So we'll see what happens by this time tomorrow. And I think the final example I have on this is on the pound Kiwi. pound kiwi looking the same. You can see it's almost the same type of scenario. We have the first level of structure here, and then we have the second level of structure down here. Now if I drop down to the 1 hour, you can see market was bearish. We had the retracement, new structure low, retracement, new structure low. Market is now kind of making a sideways movement. Now one of two things is going to happen. We have a sideways movement here. Either we break to the upside or we break to the downside. Now you can take advantage of whichever one you want, but I like my odds better if we break to the downside. Why? Because look at that risk to reward, right? It's a very attractive risk to reward. Now we haven't broken yet. Again, we'll see what happens on the pound New Zealand come the next week. But you're more likely to be successful and you're more likely to have a cleaner risk to reward or a bigger risk to reward if you just say to yourself, well, I know where the market is right now. We're at a major level of structure. We have been bullish for the last few weeks, and market has also given me a very good risk to reward if we have a break to the downside. So these are very good reasons for you to be proactive. Don't get faked out by what the market is doing here, because it's kind of like bullish and then retracement and then bullish and then bearish, retracement, bearish, and then bullish here. You can see you had a little break to the upside. So, this would happen a lot. But if you look at the overall trend, what the market is doing, what the market has been doing, you get a lot more of a clean analysis from that. So my prediction for this would be for the market would be sideways, and it would break to the downside. Now again, I have no ego regarding this. If we break to the upside, I will come in and say, yeah, we broke to the upside, and that is the way the market moves. Again, don't marry an analysis, but I just favor the downside movement more because it's just a very sexy risk to reward, man. So yes, guys. Now the next pair I want to look at. Alright, traders, so hopefully you enjoyed that market breakdown. Now I'm going to show you exactly what happened after, because hindsight is 2020, right? Sometimes it's hard, it's tough to do breakdowns and then realize that what you didn't pan out. And I'm going to be definitely going to be showing you examples of that in today's video. So let's start off with Aussie Yen. I'm going to show you every single pair that I showed you before, just to see exactly what happened and to demonstrate the points that I mentioned when I started the video. So this is Aussie Yen, right? And I made a prediction that we were going to go all the way up there. That was my prediction. That was going to shoot all the way up, almost 700 pips. And my prediction panned out up until a point. You can see, if you had entered here, as I predicted, the market would have shot all the way up to about 350 or 280 pips or something like that, depending on where you got in anyways. If you got in at this level here, as I predicted as well that you could have gotten in, then maybe you're sitting on about 280 pips or something like that. But I guess the lesson here is to don't just expect the market to do exactly what you want it to do the way you want it to do it. Okay, the market rarely just shoots up like that. It was very unlikely that this was going to happen, right? This rarely happens. Now, what you can do here is you can stay strong, you can hold this, and then, it's Friday today, so this could potentially just come back down and take us out for a loss. Or if you have some kind of a method where you can take targets off if we break a previous structure low, like say for instance, this is what I would do at some point. This is what I used to do at some point in my trading. I would figure out what level the market is breaking. So if we break a previous structure level, like in this case, you see we've broken this structure level. Market broke this structure level, we broke this structure level, we broke this structure level, we broke this structure level, and every time the market climbs to a new structure high, so every time the market creates new highs, what you can do is you can just move your stop loss below the previous structure support. So now what does that mean? So say for instance we entered a trade here. and we were predicting the market to go all the way up there. Now, fucking hell, look at that risk to reward. I wish I took the trade here, but I didn't. So let's assume we entered here, and the market climbs to a new high, makes a new structure high, and then retraces or stalls, moves sideways, creates some sort of structure to let us know that, okay, now the market is taking a break and this is base camp and it's going to shoot up from here again. Now what we can do is we can simply move our stops below that structure level, right? So that way we're just locking in profits as we move along. Now you don't want to bring it too close that you get stopped out. You don't want to bring your stop loss just at that structure level or in the middle of it. You still want to be a little bit below it, right? So you don't get stopped out by like candle wicks, because those are the worst. So structure entry, what am I talking about? Stops below structure. And anytime we make a new structure high, all you have to do again is just move your entry. And then you just move your entry again. You can see now we've created a new structure high here. Now this would be the default previous structure level. And all you have to do again is just move your stop below that structure level. So now you'll be sitting on a good amount of money. Again, this is just an example if you had entered on this level. Now in this case, you probably would have entered somewhere around this level or this level. So market is still moving sideways, and this is a swing trade. So you're probably going to be sitting on this for a while. Made that video about a week ago. Excuse me. Made that video about a week ago, and yeah, market since then has moved about roughly 300 pips, depending on where you saw me break down the video. Market moved about 350, 300 pips or so. Now we're retracing back. So all you have to do again is just move your stops below structure. You can see market came back to retest that previous structure again, and now it's kind of moving back up. Now I don't know what's going to happen in this scenario, but this is how I would have played this. Now you see, I made all those predictions. I said all that was going to happen, and it's been a week and we pretty much haven't even moved. Market just went up and then came back down. Now obviously you could have taken targets at any point, but my prediction was that market was going to go all the way up. Now it hasn't. Now this is the place where people start to do like little mistakes, and they start to like take targets off. Oh, we're back into the place where we entered, so clearly this is not going to work. Our prediction is wrong. Or people go the other way and they say, oh yeah, well my prediction has to be right, so I'm just gonna like stay strong and add more or do something silly. So all I'm gonna do is just leave the trade on. You've already made the analysis. You've already you've already had your bias. So all you got to do in this case is just just let it run. And if it turns out and if we get stopped out, you know what? That's okay too. You shouldn't get your ego involved every single time, or never really. Anytime you're taking a trade, just take the trade and just leave it, right? So I will potentially come back to this again, make another video about how this finally turned out. Now, other currency pairs definitely have closed, and I will show you how those ones turned out as well. So CAD yen, we predicted again, made a prediction that it was gonna go up, just like Aussie yen. And you can see, I believe I even used a bat pattern as an entry signal as well. I told you if you can go down to the 15-minute, there was a bat pattern here. I think I remember saying that. So in this case, you can see our prediction panned out just the way it is. Now this is the point where you start to pat yourself in the back and tell yourself that you're amazing, and then you completely forget that you were wrong the previous ones, right? Now this is where you have to again keep your ego in check. Sometimes you can do everything right, make all the analysis, and be wrong, or just be completely embarrassed. But I'm not scared of that. I'm just here being transparent, telling you that sometimes we make predictions and we lose, or we just break even, or a week later our market has not moved an inch, because every scenario is possible. But in this case, market did move a good bit. In fact, we hit target for about 400 and something pips, right? So happy days. So that's one trade not moved at all. The other trade hit target. You can see sometimes it's not about how much you know or how long you've been trading. It's just about you just being consistent and doing what you know is right, and then the rest will just take care of itself. Now, the next pair I looked at was the Euro Aussie. Oh boy. Oh boy, oh boy. That doesn't look good at all. That does not look good at all. Yeah, I think that's a losing trade right there. So prediction here was that there was a break and close below, and the market was gonna keep going and then hit the next level of structure. Now, thing to look out here for is not that I was wrong, it's your thought process behind you being wrong again. Take the L and move on. Don't try to fix it if there's nothing broken. If it's just a losing trade, but if it's a right trade, just let it be. In this case, not only was I not wrong, the market actually told me that I was stupid because we broke to the downside and market came back up, took me out, and then now it looks like we're creating a new structure high instead. So you know what? It doesn't matter. So now all I'm going to do, instead of saying, well, the market is stupid or, oh, I suck and I'm wrong, I'm going to try to fix it. All I'm going to say is, okay, well, what is the market telling me now? Right? Because I've already made about 280 and then 400 pips on those other two couple of trades, and losing 219 on this one is you know what, I'll take that. I'll take those odds every time. You know, 2 trades for about 700 pips and then 1 trade for minus 200. I'm still winning, so I'm not bothered by this at all. So now the market is telling me that it's potentially going bullish. Now I'm not gonna touch this trade because there's nothing on here that is telling me to do anything. Nothing here fits my trading plan whatsoever. But clearly I see we're not bearish as I predicted last week. So, and that's okay. Took the L and then we move on. You can see the theme here is just being able to take the L and move on, or just understand that your analysis would not pan through exactly the way you want it to. And just sometimes, like in the case of Aussie yen, you just have to be patient. And sometimes after you're being patient, you still get stopped out. And then finally, we're looking at pound Kiwi. Oof. Yeah, so that happened. Pound Kiwi did the same thing. My analysis was that you would potentially break to the downside. And if we did break to the downside, I'll be looking for a sell limit order to go to the next level of structure. But you can see I got completely shot in the face here. Market again told me that I was completely wrong and that I'm stupid. But that's okay. And I'll reiterate why it's okay. Because now, you see, the market went up, broke to the upside as I predicted. It might go to the upside. It might go to the upside or it might go to the downside. And in whichever case it happens, we have a reason to get in. If we broke to the upside, we have a buy limit order. If we break to the downside, we have a sell limit order, or a buy stop order and a sell stop order, right? Market broke to the upside, potentially stopping me out, and then came back again to the downside. That went completely against every prediction we did before any of this happened. But you know, it's completely fine, because being wrong is just a part of the business. And the reason why people can't accept being wrong is because they attach themselves to this identity that you know the ego gets involved, and they're like, oh yeah, I'm never wrong, because they attach themselves to this identity like a monolith, like a group. You go online and you see everyone is just posting blues, and there's no losses whatsoever. And then you're asking yourself, well, what am I doing wrong? I should be part of this group which is always winning. So you can't accept that just being wrong is part of the equation. So then you just keep doing the wrong thing, hoping that it changes, which is insane. Or you go about finding a new solution to a problem that doesn't exist or that you can never solve. Trying to fix not losing trades is like trying to dry the ocean. It's useless, and you're probably never gonna get to do it anyway. So you just have to stick to what's working. Because I mean, let's do the math here. So for Aussie yen, we got about 280 pips. In CAD yen, we got about 430. And then we lost Euro Aussie and Pound Kiwi. So how exactly are you losing? So there was 4 trades, 2 winners, 2 losers, and you're walking away with about 400 pips in change. So the hardest thing here is not about taking the win, because we won, right? The hardest thing here is just accepting that you lost a couple of trades. That's what's tripping up a lot of people, just saying, hey, do you know what, I made all this analysis, I was 100% sure that it was gonna go my way because this person taught me this and I learned this and I've been doing this, and then now it's not working anymore. I'm in the unknown here. My ego is involved, so I'm gonna try to fix it. I'm gonna big up my chest and try to do something else, and then you fall into the trap of trying to analyze and trying to fix stuff. So do you know what? Just take the L, take the pips. I'll take the pips. I'm here to telling you that I'm wrong, and I've been doing this over 10 years. I still haven't figured out how to not take losses. So, but you know what? Week after week, we come in, we do what we're supposed to do. We take the L or we take the win. More often, we take the win than we take the L. So I'll take that. So guys, that will be the end of the video. If you got any questions, again, put in the description, in the comment section. And just a reminder that spots are still open for the trading consultation. If you are interested in that, then click on the link in the description and book a call on the calendar link in the description, and you and I will be having a chat personally. And guys, that will be the end of the video, and I will speak to you in the next one. Peace.